Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and my colleague.
Hello there, I'm Yatin Mota.
Well, Yatin, another day of weakness on Dalal Street, and whatever recovery we saw in the second half, in the last hour of trade yesterday, was feeble. Turned out to be feeble, to say the least. Given the fact that we saw an over 150-point cut coming in on the Nifty. In fact, we couldn't really defend that 23,550 mark also on the downside. And of course, we are all waiting for earnings from TCS. IT index also under pressure ahead of that. Yesterday's recovery, completely fizzled out today. Some bit of profit taking ahead of TCS numbers. Aside of that, if you look at the Sensex, over 500-point drop coming in there as well. The mid-cap index also under pressure. The broader end of the markets have been consistently under pressure. If you look at the advance decline ratio of the last few sessions, it has been skewed in favor of losers, and today was no different. The NSE advance decline ratio was extremely poor. 1:3, that was the NSE advance decline ratio. But one thing we must say that, domestic investors have kept the faith in the Indian markets, and that's evident in the kind of amphi data that came out. Equity mutual funds have seen inflows of over 15% on a month-on-month basis. And, at over 41,000 crore rupees in the month of December. So, yes, they have kept the faith, which is why, we have, although we have seen weakness, but despite FIS selling, domestic investors are buying or have emerged as buyers in the market.
For the month of December, the SIP number was all-time high.
Yeah.
So that is the resilience of the Indian retail investor, that despite the market correction, we are looking at SIPs which were over, I think, 26,000 crores. If I'm not mistaken with the figure, I can't recall it, but it was approximately 26,000 crores in terms of SIPs that are being made only for the month of December.
Yeah, okay. So then, aside of that, Yatin, let's talk about the sectoral movers as well. FMCG was the only pocket that was in the green today. Over 1% gain coming in there. CLSA's Vikash Jain was on CNBC TV 18, and he pointed out that it's an anti-consensus call, but they are bullish on staples. I think in a long time I have heard one analyst say that they are bullish on staples, given the kind of volume degrowth that some of these FMCG majors have been witnessing. But CLSA has pointed out that there has been slowdown in government capex both at the center as well as the state level, and that could be actually a trend, or that could be a hint of governments changing priorities, and they may focus on boosting consumption in the budget. Because of that, they have taken a call on the staples, on consumer staples, and they say that they are bullish on the food-centric companies, which is why we saw the likes of Hindustan Unilever, Britannia, Nestle, all of them gaining in trade in a weak market. But Bajaj Auto was another stock that was, doing well. Top Nifty gainer on the back of an upgrade. Kotak Bank was also doing well today, and so was M&M. On the flip side, you had ONGC. That stock has been gaining quite a lot in the last two sessions. It gained 7%, but today came under profit taking. Shriram Finance was the other one that was under pressure. BPCL, Coal India, Tata Steel and L&T, these were some of the stocks that, bore the brunt of selling today. But Yatin, broader end of the markets, lots of stocks were in focus aside of the FMCG names. Chemical stocks were up and about.
Chemical stocks, especially the refrigerant gas space was buzzing, SRF and Navin Fluorine. We'll talk about that in a bit, but yes, 10-15% kind of gains coming in there. Stocks like Alkyne Lamine, NLC India, which is Navy Lignite, also did well, 4-5% gains coming in there. What was not doing well is Kalyan Jewellers. Despite a robust, quarterly update, we had the stock which moved, but soon that buying turned into profit taking. Today also the stock was down nearly 6.5%. To my surprise, Oil India also corrected nearly 6% in trade, and Philip Carbon Blacks, ASICS Logistics were the other stocks which were struggling in trade. But, stocks like Vijaya Diagnostics, PTC Industries continue to garner limelight. Both of these stocks are at 52-week highs. And also the case with SRF and Navin Fluorine, both of these stocks at 52-week highs. But as I mentioned, we'll talk about these in detail. But Nandita, what is your stock focus list today?
No points for guessing. Since you are waiting for TCS numbers, just thought we'll point out what one should be really watching out from the numbers. As I've pointed out regularly that, third quarter earnings for IT companies turn out to be a little weaker on the back of furloughs and lesser working days. But revenue growth is expected to be muted on that front because of furloughs as well as moderating contribution from the BSNL deal. These are some of the factors that would cap revenue growth for TCS. It is expected to be very flat. In rupee terms, revenue is seen down 0.06%. which is very flat, but with a negative bias. So, and in terms of dollar revenues as well, you would see some bit of weakness. According to the CNBC poll, dollar revenues are expected to degrow 0.6% on a quarter-on-quarter basis, and the constant currency revenue is seen flat, 0.2% up. That's also according to the CNBC TV 18 poll. But margins could see some bit of an uptick. We've seen a couple of weak quarters when it comes to margin growth for TCS, but that could see some bit of recovery. A couple of factors or a slew of factors at play here. First of all, rupee fall, a depreciating rupee. We know that rupee has been hitting record lows consistently. That bodes well for IT. So that's one factor. Absence of wage hikes, because wage hikes was undertaken in the first quarter itself. So that is one tailwind, and the other being lack of BSNL deal related costs. So these are some of the factors that would aid margins. So margins could come to somewhere around 24.8% vis-a-vis 24.1% on a quarter-on-quarter basis. This is the average of 7 brokerages that we have taken. There will be a lack of any major deal wins for the entire IT space, as has been the case over the last few quarters, which is why deal wins are expected in the range of $9 to $10 billion. That's according to Kotak Institutional. And last quarter, the management itself had guided for $7 to $9 billion of quarterly deal wins. Aside of that, in terms of management commentary, what one should be watching out for should be the commentary around the discretionary spends by clients, and because that would really give us some color as to how the client budgets for the coming fiscal will really pan out. Deal wins, commentary on that as to how deals are shaping up. That's something to watch out for. Outlook on revenue growth. Now that we don't have the contribution from BSNL deal, where will revenue come from? That's something that will be watched out for from the management commentary. Also demand trends in Europe and UK. Couple of healthcare related deals got cancelled last quarter, healthcare and life sciences, especially from Europe and North America. So some commentary on that front as to how that sector is doing, because all the positive commentary that we've heard from the managements of IT companies have so far been only with respect to BFSI. So how are other sectors or other segments doing? That's something that one should be watching out for. Also, generative AI, how revenues from there are shaping up. So these are some of the factors to watch out for. Stock performance, stock is up 8% in the last 1 year, but has underperformed, Infosys by a wide margin, because Infosys is up in excess of 25% in the last 1 year, and it has been consistently outperforming TCS as well. So yes, IT earnings, anytime now TCS will declare numbers. So those are some of the factors that you'll be watching out for, and the stock of course will be reacting to it tomorrow morning.
Absolutely, and along with TCS, the entire IT pack will be watched out for, because post TCS we also have the Infosys numbers which will come in. But today clearly the stocks of the day were the chemical stocks, especially the refrigerant gas space. Stocks like Navin Fluorine as well as SRF are flying in trade. In fact, both of these stocks were up anywhere between 10 to 15%. The reason being that in the US, one of the largest gas distributors, which is iGas, they have said that R32 and R125, both these gas variants have seen a steep price increase of nearly 200%, and this is on the back of a supply disruption which is impacting the overall prices. Also, given the fact that these refrigerant gases are used in air cooling, which is air conditioners, as well as refrigeration, the demand also has seen an unprecedented uptick. Equirus says that for every $1 per kg price increase, SRF's EBITDA for R32 will increase by 260 crores. For Navin Fluorine, this figure would be close to 77 crores. Given the fact that the prices are up 200%, which is almost $4 to $5, it would be interesting to see whether or not companies like SRF, Navin Fluorine would benefit from it, because it could be a temporary blip. Also, a lot of their capacity is already contracted. So, for the medium to long term, if the prices were to sustain or were to bounce at these levels, probably companies like SRF and Navin Fluorine would benefit. Currently, SRF has a capacity of nearly 30,000 ton, and that for Navin Fluorine is close to 9,000 tons post expansion for R32, which is a refrigeration gas. Most importantly, brokerages are of the view that from here on, if there are a significant amount of recovery in the demand for refrigerant gases, then Indian companies will have an advantage because they are one of the leading exporters globally, especially to the US market. So, watch out for this space. As I mentioned earlier, that both Navin Fluorine and SRF were hitting fresh 52-week highs in trade today.
All right, chemical stocks there in focus. In fact, just looking at the 5-year returns of these two stocks also, they have given returns in excess of 250%,
Yeah.
both these stocks, SRF and Navin Fluorine. But on that note, the other stock on my list is once again an auto stock and a two-wheeler stock. Yesterday, of course, we spoke about how Jefferies has come out on a note with a note on autos, wherein they were particularly bullish on two-wheelers and they were expecting double-digit growth of 13% over FY25 to FY27. Today, CLSA has also come out with a note on Bajaj Auto in particular, wherein they have upgraded the stock to outperform, and the target price is at 9,493, which sees a 10% upside, a potential 10% upside from yesterday's close price. It has been upgraded to outperform from its previous rating of underperform. The stock has seen a steep correction. We've seen a 32% slump in stock prices of Bajaj Auto over the last 4 months. But that is actually one factor that led to an upgrade, because obviously valuations have come down, and of course the company has improved its e-two-wheeler franchise as well, with the launch of a cheaper version of Chetak, and these are some of the factors that have led to this upgrade by CLSA. CLSA has pointed out that the stock is now trading at a 21 times FY27 earnings versus long-term average of 19 times or thereabouts. Now in December, Bajaj Auto's e-two-wheeler market share was at 25%. Which was driven by the launch of its cheaper version of Chetak. And the brokerage, in fact, is particularly impressed with the fact that the Bajaj Auto has managed to maintain margins at 20% despite, having scaled up its e-two-wheeler operations. In fact, in December, Bajaj Auto and TVS both overtook Ola Electric in terms of e-two-wheeler sales as well. In fact, Bajaj Auto holding the pole position there. If you look at Bajaj, it has obviously been doing well in the premium segment, with its Triumph range, but it will continue to see rising competition in the executive segment. That is the mid-range products which are aimed at the salary or working class. And if you talk about Bajaj Auto, it already holds a pole position with the launch of its first CNG bike, the first CNG bike which it rolled out back in July. So volumes there have been improving. In fact, peers like TVS have also been looking to jump the bandwagon, but experts have pointed out that it will take a couple of years for that to happen, given the complexity of the product. But of course, Bajaj Auto had sold somewhere around 30,000 units of Bajaj Freedom, which is the CNG two-wheeler last year, by November last year, and they had increased the capacity also, the production capacity also, for both third quarter and fourth quarter. And Jefferies, of course, already has a buy rating on the stock, although they had reduced the target price from 13,400 rupees earlier to 10,350, which is once again higher than where the stock is at right now. So yes, Bajaj Auto, although the stock has corrected quite a bit, Street is bullish. They have kept the faith in the stock, and of course the fact that they have ramped up their e-two-wheeler segment is something that the Street is taking heart from.
Absolutely, and we'll watch out for the entire space. Auto space obviously in focus, because next month we have the all big Bharat Mobility Expo, which is the Auto Expo, coming up with newer and exciting products.
Well, then that was all the stocks that we had on our radar, and we've come to the end of the show. But just a few minutes to go for TCS numbers. We'll get you an analysis on the numbers at around 5:10 p.m. on Money Control. So don't forget to log in for that. But for now, it's a goodbye from me and Yatin. Thanks a lot for watching, and come back and join us later in the evening.